In the dynamic world of stock trading, the phenomenon of a short squeeze often sends ripples through the market. But what exactly is a short squeeze? Imagine you're a trader who has bet on a stock's price to fall. Suddenly, the stock's price leaps upward, catching you off guard. To prevent further losses, you're forced to buy the stock at this higher price. This, in essence, is a short squeeze. This scenario can trigger a domino effect in the stock market. As more short sellers buy the stock to cover their positions, the stock's price rises even more, causing volatile price swings. This can lead to significant losses for those betting on the stock's price to fall, while potentially rewarding those holding long positions. The impact of a short squeeze can be tremendous, shaking up the market and catching traders off guard. To fully grasp this concept, let's dive into a real-world example. The year 2021 saw one of the most famous short squeezes in stock market history involving GameStop, a video game retailer. In the early days of 2021, an intriguing drama began to unfold on Wall Street. GameStop, a seemingly declining retail store selling video games, became the unlikely hero of a David versus Goliath story. A community of retail investors on the online platform Reddit, specifically on a subreddit known as Wall Street Bets, started buying up GameStop shares en masse. Their intent? To challenge the hedge funds that had bet against the company by short-selling its stock. For those who need a quick refresher, short selling is essentially betting that a company's share price will fall. Investors borrow shares and sell them, planning to buy them back at a lower price, return them to the lender, and pocket the difference. But if the share price rises, short sellers stand to lose big. As Redditors bought more and more GameStop shares, the price began to skyrocket. This surge caused a short squeeze, a situation where those who'd bet against the stock were forced to buy shares at higher prices in order to cover their positions and minimize their losses. This buying pressure, in turn, drove the price even higher, creating a feedback loop. At its peak, GameStop's stock price reached an astronomical $483 per share, up from just under $20 at the beginning of the year. This seismic shift resulted in huge losses for some hedge funds, while a number of retail investors made significant profits. The aftermath of the GameStop saga was felt far and wide. It sparked debates about market manipulation, the role of social media in investing, and the need for regulatory reform. It highlighted the power that collective retail investors can wield, as well as the potential risks and volatility that short selling and short squeezes can introduce into the market. This dramatic event underscores the potential power and risk of short selling and short squeezes. Now that we've delved into the world of short squeezes, what can we take away from this? First and foremost, short squeezes highlight the inherent risk that short sellers face. When betting on a stock's decline, the potential losses can be limitless. You see, while a stock can only fall to zero, there's no cap on how high it can rise. So if you're shorting a stock and it begins to rocket upwards, your losses can quickly spiral out of control. This is the essence of a short squeeze, and it's a stark reminder of the dangers of short selling. On top of this, short squeezes can cause significant market volatility. When a stock starts to surge, it can trigger a rush of buying activity as short sellers scramble to cover their positions. This can push the price even higher, causing a feedback loop of rising prices and frantic buying. It's a dramatic spectacle, but it's also a destabilizing force in the market. What's more, short squeezes are largely unpredictable. They're driven by market sentiment and momentum, rather than the underlying fundamentals of a company. A stock may be overvalued, but if enough investors believe it will rise, it can trigger a short squeeze. As for the most shorted stocks right now, they span a wide array of sectors and industries. From struggling retail chains to volatile tech startups, there's no one-size-fits-all profile for a short squeeze candidate. However, it's important to stress that just because a stock is heavily shorted, it doesn't necessarily mean a short squeeze is imminent. Predicting a short squeeze is no easy task, and trying to profit from one can be akin to playing with fire. Remember, while the allure of a short squeeze can be tempting, it's crucial to understand the inherent risks and unpredictability of the stock market. Stay informed, stay cautious, and keep your financial goals in sight.